Hello and welcome. Welcome. As usual, as I can see the numbers just picking up, please do type a Y in the chat room just to let us know that you can hear and see us okay. You should be able to see my shared screen. Let me know if you can. As usual, I'm joined by our editor-in-chief, Matty Alon, for the fourth part of this course. Matty, how are you
Yeah,
doing?
I'm excited. You know me, I'm always excited about this specific session. So yeah,
Bring it on.
seems like
Bring it on.
really fun gonna be today.
Yeah, absolutely. For those that are joining for the first time, do remember you can head over to the eToro Academy. You've got all the courses. So the first one we did 4 weeks ago, the investment basics, the technical analysis, fundamental analysis, all the links are there. I'm going to copy and paste that and put that into the chat for you all to have a look at in your own time, just in case this is the first one or the second one that you've joined. But thank you for joining us on this journey. Today is about building your portfolio. So we're going to do a live example at the end. But yeah, thank you for coming on the journey, whether it's been on demand or you've watched live. Remember, all feedback is welcome. I guess it's at this moment where I really want to big up the importance of the demo account, the virtual account that you have on eToro for practice. And it can be so beneficial putting some of the theory of what we've talked about into action before you then deposit live funds, for example. I mean, think of the virtual account like fine tuning your golf swing down the driving range, or guitar practice before an exam, or training at the gym, or going for a run before a triathlon. Practice can hopefully, for all of us, make perfect. So what have we done to get here? We've discussed the introduction of investing and then looked at both technical and fundamental analysis. And it might be at this point you're starting to get an idea of what kind of investor you would like to be and how it might fit in with your life as it is as well. We have a good slide in a bit, which will sort of summarize these all together. But let's just have a quick think about which investing style suits you best at the moment, or which one you think would suit you best in the future. Do you want to be more active in the market? Does your schedule actually allow that? Or in fact, would you rather just passively invest, maybe in an ETF that tracks the S&P 500 and will get you that sort of 8, 9, 10% a year, which can compound over time? Which, by the way, I mean, Matty, correct me if I'm wrong, but Warren Buffett once said, most people are generally just better off investing in index funds. So that might be something where people look to go down. Or in fact, you want to be
Yeah,
somewhere
I
in the
agree.
middle. Sorry, go on, Matty.
No, I'm saying I agree 100%. That's exactly what his point. If you don't understand what you're doing, so just why don't buy the index? And I think as you showed in the first session that we had here, also if someone missed, they can go to the recording. But in the first session, we showed what's the S&P 500 knows to do on average every year. So I guess Warren Buffett makes sense when he gives you, I don't know, sort of almost 10% annual return. Obviously, we don't know what the future gonna show, but if it's 100 years working with all the wars or with all the crises and everything we had, so why bother? And if you don't understand what you're doing and you can make this amount, so why even, work hard? So yeah,
Yeah.
definitely smart thing.
Yeah, absolutely. And then obviously we got the active, we got the passive, but it might be somewhere in the middle that suits you at home a little bit better. You have some spare time where you want to dedicate it further to your investing journey. You're happy to make decisions yourself and dip in and out of the market more frequently. Let us know in the chat which one of these you reckon you are at the moment. Do you think you're going to be more active? You're going to go down the passive route or somewhere in between? It'd be really interesting to see just a little gauge of where we are at. Let's have a look. Semi-active, the first answer in the chat. A couple semi-active as well. Okay, interesting. Passive, good mix. Lovely. So look, we thought we'd talk about routine. Whenever I do this course, I mention a saying. It's one of my favorite ones by Benjamin Franklin, who said, "By failing to prepare, you are preparing to fail. And
To
another good
fail.
one, another good one is by Vince Lombardi, who said the only place success comes before work is the dictionary. So, like, I really can't stress the importance enough of being prepared, having a routine, being disciplined, and work hard at improving yourself in this field. So, now we've got rid of the philosophy. Let's just have a quick look at the routine of a day trader. And while I go through it, again, just have a little think to see whether this would be something for you now or in the future. So let's just go through those points. At any time you might have open positions, you will need to actively monitor those during market hours, consume the morning news, and continue to follow the news throughout the day as well. There's obviously good relevant blogs, podcasts, the Digest and Invest one, of course, and social media can be great. Definitely can be great as well if you're following the right accounts. Obviously on eToro, you've got the feeds, you can engage with others, you can attend webinars like this where I can see you all interacting with each other as well, sharing your thoughts and ideas. But I think the main point here, and probably the most important one, is never stop educating yourself. Read and watch educational material that will help improve your strategy. Every now and then there's something new that comes out and is important to the markets, and it can be important to, of course, educate yourself on that. Next, we've got the daily routine of a more fundamental investor. And again, as I go through this, it's important to think whether it would suit you better or you favor it. And of course, whether you think you perform best doing it that way. Later on, we'll talk about the importance of reviewing your performance and also how long you really need to actually judge your results. So for a fundamental investor, there's no need to actually watch your portfolio all day long. And I think this is one of the big mistakes a lot of newer investors make. They're constantly watching it, and that can lead them to act irrationally, exit positions way too early because they're constantly watching their P&L, even though they got into a position with the view for staying in it for the long term. Consume the morning news, continue to follow it throughout the day. It's great and important to be on top of everything that's going on. Your main focus here, and what better than literally right now in the middle of earnings season, is going to be annual reports, quarterly, earnings, in-depth research about the company, competitors as well. Obviously, again, following the right blogs and podcasts can be heavily useful as well. And again, that point at the end, never stop educating yourself. Matty, I want to bring you in here. Obviously, you've got over 2 decades experience in this world. How does your sort of daily routine at the moment look like, and has it changed lots over the years?
So first I'll start with saying that this is probably one of the most important thing about investing, the daily routine. And the reason I'm saying that is especially during a surprise time, a volatility market, that's where we feel the most, when we are the most vulnerable for surprises, are surprises that we don't know how to react to things. And if we don't have a routine, this is exactly when we cut the routine. And when we're saying routine, and this is important to understand, is not, watching my portfolio every 5 minutes. This is not a routine. This is, as long as everything is quiet, yeah, you can look at your portfolio, everything is cool. But at the minute it's crashing, you refresh the screen every minute, and it gives you nothing aside from stress and making some mistakes. So just saying that this is how important it is to build a routine, follow the routine, and I've been doing it forever. Obviously, I have and still improving my routine to fine tune what's working for me. And this is important because every person reacts differently to stress. Okay, it doesn't necessarily, by the way, have to be the stock market. It can be for anything in life that happens. You react to stress. So you know yourself the best. On the contrary, what you also need to take in mind is that there are some uncertainty that we can know in advance that happen in the market. We know there are surprises. We know there are crashes. We know there are good surprises. We know that the market is not predictable. And if we are, as a people, are people that are getting fast stressed, Maybe the regular stock market buying a very volatile asset is not for us. That's why it's really, really important understanding that. When you understand it, then you can build the daily routine that fits you. And what I mean by that, some people will watch all day long the screen, but some people, as I said, it's too aggressive for them. Some people will not watch the market for a week because they will say, hey, I bought for the long term. This is my strategy. The only thing I'm going to spend time on is maybe learning more on my business. But listen to that. Learn about my business doesn't mean let's see what the stock of my business is doing in the market. It's two separate things. It's two different things. It's so important to understand what works for you as a personal person and not what works for the whole, because if you will join the crowd you will get the same result that the crowd will get, not the result that you will get. Now try to think always as a business owner. Warren Buffett spoke about it, and every investor should think about it. And why I'm saying that, every one of you, either if you have a private business or if you have a regular, routine life, learning, studying, doing whatever you're doing sport, you have a routine. You're doing it. You don't just, do nothing. If you work out 3 times a week, it's a routine, right? It's important for you to work 3 times a week. It has nothing changed. Nothing is changed different. I'm sorry, with investing. You need to have the exact thing that makes sense for your investment strategy, and this is how I do it. Every quarter, I'm getting ready before the quarter report to my companies. So I know what to expect for. I'm not waiting for what's the analyst expecting, and then I'm saying, okay, it beat it, it didn't beat it. Because as we saw, for example, yesterday, Google beat all whatever expectation, but share is down 6%. I don't know how much it opened today. If someone wants to write, be welcome. But it's down heavily. And guys, we're talking about trillion plus a company, right? I mean, it's an insane move in valuation. But why it happened? Because the cloud, oh wow, 8.5%. Because the cloud wasn't growing like the market expected. If you would invest in Google and you would know that, maybe you would look at that as the best opportunity now. Market is lunatic. Hey, they're down 8.5%. This is the opportunity. But that was happening only if you were ready and waiting and understanding how the company is working. But if you weren't, the only thing you're going to do is just sell now. Why? Because everybody is smart. I cannot be smarter. And that's the problem. So for me, it would always be, prepare for the earnings season, read before I do anything, the report of the company I invest in, because again, I'm the business owner, not some headline in some newspaper. Listen to the conference call. And that's the routine. And between the earnings season, I will learn more about my companies. I will search for more companies. I will read more content about competitors. And I will also read a lot of education, listen to podcasts, and do all those things, which obviously we offer them, but there are many others as well. So that probably would be my daily routine. I'm sorry for the long answer, but it was just important to mention that.
It's a good answer, and it actually brings me up to a nice point. I saw this recently, and I've just found it again. There's always a reason to try and convince yourself to sell. This is just a chart of the S&P 500 going back to 2009, and these are all legitimate headlines, by the way. These are things that move markets, but look, you can see there, bottom left, 495% from the March 2009 lows. There's always a reason for you to convince yourself to get out. Remember to have patience and long term, and obviously experience does help, but that's one of the reasons why we're here putting on this course. But really interesting chart. I think I might just copy and paste that into the chat for everyone to have a look at in their own time as well. So yeah, those are the routines that you may want to look at. I'm sure you can take a little bit from each one of those. Here we've got a bit of a summary of those different styles, and it can also help you a bit in making your decision. If you work full time, you don't have much time to dedicate to investing or learning how to invest or trade more actively, then you're going to probably fit in the bottom right section of passive fundamental investing. Whereas on the flip side, if you want to become a day trader, you're more active, you want to commit and learn to that, then the top left is probably going to be more of you as well there. So the active and the day trading side of things as well. But yeah, do take a moment.
This is, by the way, this is a key point, and I guess Sam, you can share it with everybody, because a lots of day trading, technical analysis strategies for the day trading, telling you like the free courses that you can make tons of money on the side. But how important, and this is a question for you, this is the point of active, because doing something on the side and being an active, it just doesn't work together. It's either this is the professional work, or you really can do it. Okay, I'll do it half an hour a day and that's it.
Yeah, I mean that's it, right? If you're going to do active day trading, you've got to give it 100%. You can't just think, oh, I'm going to turn my computer on at lunchtime and just trade for 2 hours in and out the whole time. It's not going to work. That you've got to remember as well, you are competing against people that do it for a living, so you've got to treat it with the same energy as they would. Now, what I do now, I work full time for eToro and I swing trade, so I'm not actively in and out the market. I just don't do that anymore. So for me, it would be, I look at the market a few times a day, but I'm looking to potentially position for a series of days or weeks. If I were to, for 3 hours, sit down and trade, chances are I probably would lose money because I'm not prepared enough for it. Whereas if I was to actively day trade the whole time, I would build myself into that and I would give it 100% and increase the chances of doing it right. You've got to be committed to which one you do there. But yeah, great question. Next up for us is again just going to focus really about building the plan. You'll probably be quite pleased to know that I don't have another philosophical quote for you all, but it is important to have that plan, and it can be adjusted along the way. I think that's also important. It's absolutely fine. We aren't just choosing one way and sticking with it for life. Our plan can be adjusted during the learning curve, and it can also be adjusted through self-analysis when we review the results, how we felt and what we wanted to achieve. And I remember speaking with Matty a while back when we were putting this course together, and we were saying, you probably need at least half a year to actually do some proper analysis on, to look back and actually take, if you're just to do something for 2 weeks, you can't reanalyze it. It's not a big enough set. So, for those that are on the demo account, if you've got that 6 months behind you, you've got a solid data set, that you can then look to review. And of course, on the eToro platform, you've got that virtual account where you can do bits and pieces there. But yeah, look, you must build a plan. It's very, very important. If you're a fundamental investor, define your investment philosophy, strategy, and routine, and be prepared to stick to it even during negative periods, like you just saw, like that link that I just put in. If you're a day trader, stick to your process and routine while setting realistic goals for each day, week, month. Risk management is vital. I can't stress that enough. And remember to never trade without a stop loss, especially during volatile periods. But then look, you get to a point where once a quarter, you can review your plan, what worked, what didn't, and then update accordingly along the way. We're now going to sort of move into structuring your portfolio, and we'll get a bit more hands-on with some practical examples in due course. I mean, to put it very simply, when describing capital allocation, it is the way you set up how your capital should be divided. So through diversification, for example, which we're about to touch upon, one thing that I find very useful and interesting is looking at successful popular investors on the eToro platform and viewing their portfolio. What do they have in common? How much capital do they give to each investment? It could be so helpful seeing how the pros do things. Like if you wanted to master a certain sport, we have lessons, we watch tutorials. But at the end of the day, of course, we learn best by doing. And this is why the demo account is very useful again then. But it's something that I would recommend doing, having a look at some of the most popular investors popular investors on eToro and have a look to see how they perform. You very rarely will you see a big capital allocation just into one stock, for example, and usually there's method for that. We'll talk about that and we'll go onto the platform shortly. We've said this, I think, either last week or the week before. Diversification is probably one of the most used words in eToro history, but for good reason. You've heard the saying, don't put all your eggs in one basket. And of course, it's a great way for us to remember it's important. But let's actually have a quick look at this in a bit more detail. The idea behind diversification is managing your exposure to volatility. Since assets volatility varies from one to the other, it's extremely important to allocate your portfolio accordingly. Limiting how much you invest in a single asset is also a way of reducing your exposure to volatility and the risk of losing a large portion of your capital at the same time. Just have a little think. You don't need to write in the chat, but let's just say you had 80% of your portfolio just invested in one stock. Obviously, the upside potential is that it all goes to plan, it goes amazingly, and you look like an absolute genius. On the flip side, if they have maybe a poor earnings report and suddenly you're 8% down like Alphabet is today, is a big chunk of your portfolio. So this is why we really talk about the importance of diversification. Matty, for you, it's something you're very passionate about. People should need to understand this properly, though, don't they?
Yeah, no, definitely. Diversification is probably the highest protection you can have for many things in the stock market. The emotional, the loss, and many other things. However, many people need to remember, and this is probably for a certain amount of people, diversification, as Charlie Munger called it, is that it's the dumbest thing you've ever heard. And it's funny, right? Because one of the smartest investors of all time saying that, but the whole world talking about diversification, by the way, also Warren Buffett. And I just pointed out like a few minutes ago, but it's important to explain the difference between the two. Diversification here to protect every person when you don't control something. If you control something, you also need some sort of a diversification, right? But then there is the question, and Sam and I spoke about it a lot when I came to be the editor-in-chief. So, it was like, everybody was saying diversification, but I said, what do you mean by diversification? 100 shares, 2 shares, 5 shares, 50% bond, 50% stocks, what it means. And the simple answer is that diversification is split into 3. There is the diversification of the quantity, as we can see here, of the asset class. There is the diversification of asset classes, and there is also the diversification not of the tradable asset classes, but there are diversification of non-correlated classes. So, for example, if you invested in property in Europe and you bought stocks in the stock market, you literally have uncorrelated diversification. If you invested in the stock market and you diversified between gold, bond, and stocks, this is uncorrelated to each other. One can go up, one can go down. And in your specific portfolio of the stocks, you also have a diversification. So why it's important? Because if, let's say, you have 2 companies, one went bankrupt, you just lost 50%. But if you have 10 companies and one went bankrupt, you lost 10%, right? So that's why diversification is something that a person needs to understand the volatility, if he can handle that. Now, to Warren Buffett and Charlie Munger point, Warren Buffett point is that as less as you know, as more diversification as you want, right? Because you don't want to see fluctuation, because by fact, we as a human being reacting to unknown with emotional. That's the first thing. The second thing that Charlie Munger is criticizing people for doing diversification is not because it's not good. It's because it's if you are a professional and know how to do a proper analysis and know the business, it makes no sense to buy another 6 businesses just for the sake of diversification. And I will give you the example, which will probably will make the stone to fall and understand Charlie Munger point. Let's say you build a successful business, okay? Let's say your name is Yoni Asia, and you're the owner of eToro, and you build an amazing business. And this business is making and successful and has 2 amazing people, Mati and Sam. I'm just playing with you all, but yeah, I mean, and the business is good. So now what Yoni, in order to just do diversification, need to sell 50% of his business and just go now invest in uncorrelated business of, I don't know, growing chicken. It makes no sense. He understands his business best. He built it from scratch. He understands the innovation of the fintech world, and et cetera, et cetera. And by the way, seriously, now it doesn't matter what type of business you're doing. You don't diversify just for the sake of diversification if you understand what you're doing. That's the point of Charlie Munger. That's why almost forever he invests like most of his money in 3 companies. And you know, that's the strategy here. But it's not for everybody.
Not
no. Easy.
No, for sure. But important to know it. And I like the example.
And one last thing, I'm sorry, Sam, to cut you, because this just came to my mind. When you're not diversified, what are you afraid of? Let's say the shares are not going to go bankrupt. But if one is going 50% down, you're stressed, because let's say 1/3 of your portfolio is down 50%, you're stressed. But let me give you something that I used to write to my investors. I wrote to them, I think it was in 2011. And I always remind them, in 2008, the S&P 500, 500 companies of the biggest companies and best companies we can say in the world was down 56%. So you would have 500 different company, different location, different product, one of the best brand names that we're using every day, 500 different assets, and you still would see your portfolio going down 56%.
Yeah.
So by itself, diversification is not a protection from volatility. It's just the protection from making one big mistake that you cannot recover. That's the idea.
Yeah. No, absolutely.
Sorry
absolutely.
for the long answer.
No, it was a good answer, and then you know it's good to as well for people just to have that perspective, and also the slide that you see on the screen. You can sort of see how you can diversify should you want to buy a certain investment style or asset class, or even within a certain asset class. Obviously, just for illustrative purposes only there, but you can see the bottom right, just some companies that people may want to have looked at if they wanted to diversify within, but you can have a higher weighting to, certain stocks. And in this example, I think it's Amazon, 13%, Apple, 7%, but it could be whatever, right? Let's have a quick look then actually at Yoni's portfolio on eToro. Obviously, you can just type in Yoni Asher, but like I said, do this for other popular investors that have done well. Why have they done well? What do they have in common with each other? You can, on the portfolio page, there's a pie button, top right. If you click on that, it shows you the exposure, and you can do that by allocation or risk. But I mean, look on here, you can see 46% into stocks, 37% crypto. ETFs make up about 15% of that, and you can highlight over that to sort of see and have a little look through there, even going through just each individual weighting, that 5% test. And like I said, it's very rare that you would get someone that's super successful over a long period of time that really invests much more in just one particular stock. But here it's quite interesting, and I think it is worthwhile people taking time to do this. And I mean, look, Yoni has had it is probably worth saying, when he does well, he does very well. The bad years maybe take a little bit up, but he's happy to take on a bit more of a risk in this portfolio. So it does also depend on each person's appetite. So you want to see where maybe it feels similar to how you would like. But, it is useful, Matty, I think, as well, that people can take stuff from this page. What do you think?
Yeah, definitely. I mean, you can take a lot from this page first to understand what's the strategy of a person, even if you're just doing a copy portfolio
Mm.
or by the way, even if you invest in a fund, even if you invest in an index, right? A dumb index that is not actively managed. Some people are choosing, I don't know, an index of the house building. You can literally look at what companies you have in this index, right? To see the exposure and everything to do with it. So it's really, really important to understand, to look at that this way, and also to understand each type of assets, what's the risk there, right? Crypto, we know what's the risk. Stock, we know what's the risk. ETF, we know what's the risk. Some people will look at Yoni's portfolio and would say, oh, this guy is insane,
Yeah.
37% in crypto,
Mm.
right? You probably Yoni will come and will say you're the insane one that no, but seriously, this
Yeah.
is the funny part. I mean, people will come to Charlie Munger and they will say you're insane. The third of your money is within Costco, one company, right? Well, again, we're not here to prove who's right and who's wrong. It's just your personal appetite.
Yeah.
But I guess the main goal, and we spoke about it last episode, is the compounding. As much interest compounding we can make, return we can make, that's what we care about.
Yeah.
If we do it with more exposure to crypto, if we do it with more exposure to stocks, so be it.
Okay.
That's your goal. Your goal is not looking and saying this one is wrong, this one is right. Is what you are able of making. One important thing on this as well, and someone here mentioned something about Charlie Munger also investing in real estate. You need to be very careful when you look at exposure of portfolios because maybe this exposure of this particular person, the whole portfolio, maybe it's 5% from his whole net worth, which is in real estate, right? So it's also important to understand it and ask those questions. And also for you, as a person who manage money, make sure to understand the exposure of your total asset of the stock market from your total asset. Okay, that's just one more point.
Yeah, no, absolutely. Absolutely. I think it's important. And obviously, guys, feel free to put in questions throughout the session. We'll have some time at the end there as well. Just while we've sort of been talking about sort of diversification and portfolio, it reminded me, Matty, of a conversation with leaders episode we did earlier this year or last year with someone called Dan Ariely, and we talked about
Oh
an
yeah,
exercise that
I'll
he
I'll
does.
find the link and I'll
Yeah,
share it.
it's really interesting. We talked about an exercise, and I'm going to ask everyone here the question. So if I, let's just say I had the power to go into all of your current portfolios right now, and I took every single position off and put it into cash, would you, when you got that cash, would you then go and get into exactly the same positions again? Now, if the answer is no, and you kind of sort of, deep down that you should probably change your portfolio. If the answer is yes, then you're very confident and happy with that portfolio. So let me know if I was to do that, would you all get back into exactly the same positions, or those losing positions that you don't really want to be in anymore? Would that be the good opportunity to leave those alone? Let me know in the chat. But we're just going to talk a little bit about rebalancing. And when we talk about it, it is important, as Matty was just talking about, to actually understand our strategy. Is it to save for 20 years, or is it to try and make more money in the short term? This, of course, will affect how often we do rebalance. Things for us to consider are, well, what is rebalancing? Portfolio rebalancing, we can say, is the process of adjusting the allocation of assets in a portfolio to maintain desired risk and return levels. For example, let's just say we're relatively moderate in our risk approach and we had a 50-50 split between bonds and equity. If equities had a good first half of the year, but bonds don't, our split could now be, say, 60-40. This is not in line with our risk profile, is it? Right? We wanted 50-50. So guess what we do? We sell 10% of our equity holding to get it back to 50, and then buy more bonds to make it equal, get it back to 50-50 to equal it all out. Now, how often do we do this? Quarterly, semi-annually, or yearly, depending on how active you want to be. You may choose to rebalance when there are changes in the market. Fixed income a couple of years or a few years ago made no sense, whereas recently it's been a lot more attractive. So we do need to stay up to date with different macro events. Again, we can talk about that shortly, but you can see the importance of rebalancing. Matty, where you are at right now, how often would you rebalance yourself, or does it vary?
So I think so. Basically, it depends on the volatility of my portfolio. So if, for example, I have a company and it's 20% of my portfolio, and the whole portfolio, I don't know, is down this month 5%, but this particular company outperformed like yesterday and jumped 10%. So it will change the allocation, and I may decide to reduce a bit the exposure to the company that became, I don't know, 30%. Me personally, as a person, I'm not doing it because for me, I'm holding businesses. So I don't really care about if something become unproportional from perspective, because I'm have almost zero diversification. But I mean, if your strategy is always still sort of a balance, and by the way, the word balance, it depends on you personally, what's a good balance for you. So for example, you can say, okay, I always want 2% at least in Bitcoin, I don't know, 48% in bonds and 50% in stocks. No matter what change, you need to be active and change it, right? Because this is the strategy you wanted.
Yeah.
But I fairly agreed with you that in order not to be that active, unless there is a movement, and this is a strategy I know many are doing, of more than 5%, I think even Ben Graham wrote about it like 80, almost 100 years ago. If you don't have only when there is a 5% movement in the portfolio towards specific, asset, then you rebalance. Okay, so if you have 50-50, one is up to 55, one is down to 45, then you sell the 5 and buy the increase the other 45 to 50.
Yeah.
That can be something like that.
No, for sure. It's quite interesting just reading a couple of the responses to the question. Yes, I would change it. I will change. No, definitely not. I have about 10% of my portfolio that I don't agree with. If I was to buy these stocks again, I'm waiting to break even and close them. No, yes, I would reopen the majority, although one investment would be a no. I'm already looking at exits on this, which is good. You're preparing for that. I don't have anything against that. I think that's smart play. Day trading or long-term investing, a lot of you already have an idea of which route you would be wanting to go down. However, some people will combine both strategies. Can have part of your portfolio in longer-term investments, while another could be used for day trading. Combining two strategies can help reduce your risk as well. It is worth saying that. And that is maybe something that a few of you are thinking to do. You like the idea of being a little bit more active, but you also want a larger pot for your longer term investing to compound over time, over the next 10, 15, 20 years, for example. In essence, this is kind of how I how I sort of go about that. The macro effect, hopefully over the last few weeks, you started to understand a little bit more about what can move markets. But the point here we want to make is how different investors and traders take on this information. For a fundamental investor, we want to think, how will these events affect markets? Can inflation send some of my stocks lower? Can rate increases benefit any of the bank stocks that I might own, or potentially harm my tech stocks that I own? Or if I'm looking at buying Exxon, can information from the oil inventory data help aid my decision? If we were to see continued drawdowns, which is essentially less oil being produced, and then lower supply, can actually help oil price and therefore help companies like Exxon. So we're thinking like that way, from more of a sort of a fundamental approach. And there are a few things that you might want to look at and pay attention to: the monthly inflation reading, the monthly rate decision. There's 8 a year, we should say, from the FOMC, the Federal Reserve. Monthly GDP, the oil inventories, companies' earnings report, who are right in the mix now of some of the biggest companies in the world reporting. It can move markets. And if you think, if a certain tech company does well, that can lead to another one potentially doing well as well, or likewise and vice versa. But yeah, these are things that I think it's worth, understanding, having a general bit of knowledge about as well, because that can, of course, affect your positions that you have. Let's get a little bit more practical now. I actually need to update this. I'm 32. Can you believe that? 32 years old, and I look this young. But for the example,
you don't say it to a person that is turning 46 very soon. I mean, this is insulting.
Oh dear. I'll enjoy my years while I can. Risk profile, I'm going for moderate aggressive, in my opinion, with the horizon being for the long term. Prior to coming on this webinar, I sort of devised this plan. This is something you hopefully are all starting to do yourselves, in sort of how you would look to produce your portfolio. And I've seen a lot of questions over the last few weeks. How do I, invest in the S&P 500? Well, one of the ETFs that I'm going to invest in is going to be an ETF that tracks the S&P. So we'll go through that. 70% in stocks, 25% of those ETFs, 25% individual companies, 5% commodity related, 5% currency. So I'm spreading my risk across the board. 10% for bonds, fixed income, and then 15% crypto. I'm happy to be a little bit more risky, if you like, in that portfolio. And I think crypto is an asset class that has the potential to do very well. However, if it doesn't, I don't want to have too much tied in. I'm not going to do a Yoni Asia and have very, very big portions of that. But again, he may say, Sam, you're crazy, but he's absolutely entitled to have that opinion. Let's have a look then. Let's just go to portfolio. I've got $89,000, but this is of course a virtual account. That would be nice though, wouldn't it, to have $89,000 ready to invest? But as I said, we're going to go through a couple of ETFs, and I'm going to sort of copy and paste into the chat as I go through just some examples. And that is important to stress. These are just examples. This isn't me picking the portfolio that I would right now. It's just purely hypothetical. So one of the first ETFs that I'm going to invest in is going to be the SPY, the SPY, which tracks the S&P 500. And again, you can search up there. You got Discover. I mean, even just using, Chat GPT, what are the 10 most invested ETFs out there? Or what ETFs track Europe, for example? Just things like that you can help yourself with. Obviously, you've got a little bit of information there, but let's just get straight into it and trade. Now, the amount, as I said, it's about 5%. Which I think, if my maths is correct, is about 4,400 roughly. And for this example, you can see that that's pretty much right there. So if I can get in here, and I don't necessarily need to take profit on that. So take that off and I can buy. And then I can sort of go through how I would want to do this. I might want a bit of exposure, as I said, to Europe. And there's an ETF called Europe, for example. And again, I can invest 5% in that. Let's just get in the amount. And I can get in there. Again, don't need to take profit on that. I'm going to leave it for a longer period. And then what you can see as we go through this, as my portfolio starts to build up, you can see just how it starts to filter through. I also maybe want some exposure to QQQ, which is more sort of focus on tech and the NASDAQ, for example. And it's a little bit more volatile, shall we say, than the S&P 500. But if stocks do well in America, that could be, really good sort of reward for me there. And again, same kind of thing, just putting that on there, buy, and I can do this. It might be that I want some exposure to other parts of the world. So China, for example, I might be sitting here and saying, I think in the long term, China is going to become the biggest economy in the world. It's going to be a good investment place for me to invest in. Maybe not right now for the next couple of weeks, but over the long term, it's more interesting for me to do that. And again, let's just get in roughly about 5% of that. Again, don't need my take profit on it. Buy. And you can see that's gone through there as well. And it might be that the last ETF that I'm looking to is just the total stock market. So the Vanguard total stock market ETF. And again, as I said, you can show more and you can see a lot of information about that. You can see the chart as well, should you want to make a more informed decision. Remember, you might want to use technical analysis and say, I want to buy this ETF, but I'm actually going to wait until it hits a level of support like it did in May this year, for example, if you wanted to be picky. For this example, we're not going to be. So we're going to get in there as well. Lovely. That's my ETFs taken care of. Buy, and that's done. So we can see the portfolio starting to take place there as well. And then stocks. I mean, look, some of you just give me some examples while I type in some other ones. It might be Amazon is a particular market that I like the look of. I've already seen someone say Tesla. I don't think that's too much of a surprise for many people. For each of these, I'm going to go a little bit less exposure. I'm going to go sort of 2.5% maybe of my portfolio, so I can have a few more different stocks. Let's get that Tesla in there as well. Again, 2200. And remember what we said earlier, it might be that every half year or every year or even every quarter, I potentially look to make decisions to rebalance things, or if something massively has changed from a macro point of view, I might want to add to a position or get out of a position completely. But what I would say is the last thing you want to do is build up your portfolio and then within 30 minutes, you're already moving things around, exiting straight away just because of one bad day in the markets. There's going to be bad days. Of course there is. But as we know, certainly for like the S&P 500, for example, history is on our side. Someone said McDonald's, let's get in that as well. Interesting chart, actually, McDonald's. I was looking at this the other day and you can see, if hopefully it loads up, just how we're coming back to a very, very important level. Look at this, 260 for McDonald's, very, very important. The market clearly cares about it, whether it be a ceiling to stop the move going higher or a floor to stop it going lower. We're almost coming back to that as well. Let's say I want to have some exposure in different parts of Europe, for example. It might be Spotify, which is of course a Swedish company. Correct me if I'm wrong. Yep, Swedish company. Okay, let me get in a little bit of this as well. Only for my take profit, I'm just going to hold that to there. Might be a little bit of France, LVMH, which has obviously had a interesting time recently, just been overtaken as the biggest company in Europe by Novo Nordisk. Maybe that's another company for me there, Novo Nordisk. I can get in to have some exposure there as well. Just going to do one more stock just to show you how that can then look like. Let's just get that into picture here, 2200. Nice sort of 2.5% of my portfolio. So you can see I'm quite nicely diverse now by different companies as well, different parts of the world. Now, obviously, I would build this up. It might be I have some Alibaba, has some Chinese exposure, Rolls-Royce, UK, for example. It might be that I want some exposure to the gaming market. I have Roblox, for example, and I might want some exposure to oil-related companies in different parts of the world. So Shell, for example, may well very much be a company that I look to invest in, as is Exxon. If you don't want Exxon, there could be Chevron. And again, this is just purely hypothetical. When you make these decisions, you might use the information from the fundamental analysis course as well to maybe see which certain stocks you like the look of a little bit better. I mentioned I wanted some exposure to bonds. So there's different ETFs that we can invest in there. AGG, iShares Core US Aggregate Bond ETF. That might be something where I want to have some exposure to. And again, it might be 4 or 5% of my portfolio roughly for each of those as well. BND, another ETF. Now, obviously, I can sit here and I can name all of these ETFs, no problem. you've got the Discover tab as well, where you can find out a little bit more about each one. So do take time to look which ones maybe suit you a little bit better than others. I mentioned as well, I wanted a little bit of exposure to currency. So it might be that the US dollar index is maybe somewhere where I look to invest in, because I want some, a lot of people will consider the dollar as a safe haven. If things start to get bad in the world, people want to buy dollars. Okay, maybe that's always a good little option for me to have. And again, it might be I just have a little bit of exposure there. And obviously you can do that one leverage, just set that and so on, or getting an ETF as well that tracks it. Bitcoin, for those that are tracking it, you'd have seen recently it went up to 35,000 the first time for a while. We can see this on the chart here. Look at this. Put that on the weekly chart. We're level to keep an eye on 36,000, 37,000. That's one where I'd focus on. But again, here we might want a certain portion of my portfolio in Bitcoin, a little bit less in other crypto assets, like say Ethereum. Someone else give me two other crypto assets for me to invest in. First come, first serve. Doge wins the battle. Elon Musk will be happy with you for saying that. So a little bit of exposure to Doge there. And we've gone Tron as well. Let's just get that in. Did I buy that? Yes, I did. Lovely. There as well. So you can see I'm just sort of building exposure for different crypto assets, favoring Bitcoin, which I feel is going to be the better long-term option for me, less volatile compared to maybe some of the other crypto assets. And you can see, look, we've still got obviously a bit of room for me to invest, cash available 30. So I would have, if we had a little bit more time, invested in some of the other assets that I talked about to just fill this up. But what I also think was important is, I guess I can come back to you here, Matty. Some people like to have part of their portfolio in cash, whether that be for a dip in the market, whether that be to add to positions at a later date. How do you feel about that? Do you think it's always useful to have, say, 5%, 10% in cash, or does that change throughout the environment that you're in?
So I'll give you an analogy. Let's say your entire assets in the world are, I don't know, 1 million. 700 is your house, okay, which is also an asset. And let's say another 100 is your car. I'm just throwing numbers, and another 100 is some whatever investment you have, and then 100 you have in the stock market as like tradable asset. What's your goal? Your goal is beating the market, right? That's why we call it the stock market. And if this is your goal, go to your goal and see if it has cash. The S&P 500 doesn't have cash. It's 100% invested. Okay. If you have cash, it means that you believe that you're smarter than everybody, that you may have a crystal ball, and you will know when exactly to use this cash in order to time the market and create an alpha. Now, I will ask a question. Also, you, Sam, how many of you, when the market was down 7%, actually took the cash and bought? And how many of you said, oh, it's down 7%. I'll wait for it to go down 10% just to see it going everything up.
Classic.
Everybody, I'm waiting for the answer.
Yeah.
Bring it on. I want to see the person that actually bought when the market was down.
Yeah.
It's a crazy psychology game. And that's why, I mean, if it gives you a better sleep at night, so yeah, hold cash. But unlike that, cash doesn't make money. Especially today, by the way, you can earn interest on your cash, and you can have it for a short-term bond ETF where you get 5 or almost 6% a year with almost risk-free. I mean, you need the US government to go default in order not to pay it. So, I mean, you get 5%, but just go, I don't know, a year ago where you get 0, it makes no sense. And then you have inflation and you lose a lot of money. So if you take all these things together, that's why I personally don't like cash.
Yeah, no, it's interesting just seeing, some people are in favor of it, some people aren't. But it's always useful to get different opinions on that. So here is, this obviously the portfolio. I'm just going to get into a few more ones, and we can always review this, by the way, in 3 months' time. If anyone does want to, come back to the next course, we're always more than happy to have you with us. And you can, of course, watch as many times as you want as well. Is important to say that we'll never charge for the course. Always happy for feedback. Let us know if there's anything in particular you would like covered next time as well. We're more than happy to do that as well. But there is my hypothetical portfolio: 70% stocks, bit of room for fixed income, crypto, a little bit left for cash. But I've also diversified within the stocks category, different companies from different geographical regions as well. But again, hypothetical. Please do remember that. I don't want anyone getting exactly the same portfolio and then ringing me in 3 months to be like, Sam, you told me to do this. I didn't. Hypothetical. Let's talk about the summary then, just before we go through any questions. Understanding what type of investor you are is key. Really is. And remember, plan, prepare. Develop a routine and strategy. It's imperative for success. It really, really is. I've worked with many people, even just on a trading floor, where they've come in straight away into the office, put a trade on, it's worked, they got lucky, and they think that's going to be them for their future. It doesn't work out. Things eventually catch up with you. Have a routine, have a strategy, work on refining it over the years for sure, but be as prepared as possible. Work out where you want to allocate your capital. Diversification can, of course, be a very useful tool if applied correctly. That is, again, very important to note. Rebalancing your portfolio can help maximize your returns. You're rebalancing based on your risk appetite. Remember, though, and the strategy that you had. Stay on top of the news and be prepared to react accordingly. But long-term patience is, of course, advisable. Matty, that brings us to the end of part 4. Obviously, we've got time for
the
any
final
questions.
part 4 end, which is a lot of questions. So,
yes,
yeah.
exactly. So any questions, now is the time. I'll have a quick look as well. But if there's any questions in particular, Matty, that you wanted to address, you can.
Yeah, I promised. Wait, someone, let me find it.
Just while you find it, Matty, there's a question here. Will these course sessions and chat be available afterwards to review again? So here, yes, exactly the same link that you clicked on to watch this. Give it 10 minutes and it will be available. And you've got all of the recordings available in the academy, and you can watch whenever you want.
So Diana Funetes, I'm sorry if I didn't say the name Funetes. So Mati alone so passive investor don't compound earnings and they don't sell. No, the idea behind compounding the earning is as it sounds. You have earning, and if you take the earning out and spend them, so you don't compound, you don't make more money. And when you invest in a stock market, especially in a passive way in the S&P 500, and it's important to many people to understand, there is the S&P 500 TR, which is the total return. So what the S&P 500 total return does, it's investing the profit back into the business. While the regular S&P 500, which is either the SPY or the SPX, they distribute dividends. The idea behind compounding is taking those dividends and invest again in the same asset. And that's reinvesting your profit and let it compound. So hope that helped answer your question.
I'll take this next one. Good one from Alan. Thank you, guys. Quick question. Would you recommend taking profits? And if so, when? I have a position that is up, but I feel it may be now slightly overvalued, but unsure. Of course, you can look at that through the fundamental side of things, but also technical. Let's just say for example, the position you're talking about is Meta, and I have absolutely no idea whatever market you're on about. But just for example, it might be that you've invested near the bottom 12 months ago, literally to the week last October. It's doing phenomenally well. You're sitting there very, very happy, very smug, but you think, you know what, maybe now it is time to take some profit. The point is, you don't have to take everything. You can take maybe a third of the position off, book some profit, and let the rest run. It might be that what you'd look to do is, and you can see here, a very, very important level. Last time we traded at 327, we went all the way lower. We hit 327 again, we go down. We hit it again, we go down. It might be, for example, whatever chart you're looking at has a very important resistance level, an area that other traders and investors are looking at. You say, that's going to be somewhere where I take a little bit of profit. And then the next point where I do might be the previous all-time high. And then I leave some to hopefully continue to run higher and higher and higher. You don't always have to come out the position exactly at the same point. So you could say,
by the way, it's all about probabilities.
Yeah.
Because there is a probability and a fair one, and that's the whole, I mean, correct me if I'm wrong, but it's the whole strategy behind technical analysis is that the past will return. And if you saw that happening, the probability for that to happen is there. And if it's there, taking some of the profit doesn't kill you. No. And yeah, we may feel bad about, if I wouldn't touch it, it would continue going up. But Sam can share with you how many times he said that, but then he said, if I would take the profit and then not losing so much. I mean, it's really probability game. And as long as you teach yourself to behave like that, you will understand how making money turns to be much easier than you think, because that's just the way to make small amount and not just try to be greedy. So
yeah, absolutely. And just from a personal example, I had invested in Exxon during the sort of the middle part of the pandemic. So it's in and around here. And actually it's got it's a good example for a couple of reasons. I probably bought it probably about March, June time, went well, but then came lower, but I still had the patience to hold it. So at this moment here in November, October 2020, I'm losing money on this position. However, I held it and I decided that when it got to the 2014 high at 104, that's where I was going to get out. And look what happened. I hits 104 and then goes all the way lower. Yes, maybe now I'm a little bit frustrated that it has gone a little bit higher, but the advantage of taking the majority of the position here is that I still have some left, but the majority was taken there. It's now risk-free. It's in theory, a great trade. They aren't always like that, of course, but you can see the advantage of having patience and also using a little bit of technical analysis in the mix there as well. Any other questions you wanted to go over, Matty?
No, I think that's pretty much it. Let me see. Can you please, what profit loss you already did?
Here's a question which I can answer very quickly. In eToro, can you sell part of your stocks or take profit? Yes. I mean, look, obviously we just got into a position, so I wouldn't recommend doing this, but let's just say for whatever example, you wanted to get a little bit out of this Roblox position that we've got. So when we go to our portfolio, we can, for example, close a specific position of that or like a certain amount. And it might be that we decide to, take a third of that position off, for example, or whatever. So we could exit the trade, take a certain amount off. But yeah, you can do that. You don't have to get all out at once. Any final questions? Let me know.
I'm trying to see here. I don't see anything else. I just will answer. Many people ask if this is the last session. So yeah, it is the last session for this quarter. Next quarter, we're gonna start another round of those 4 sessions. We do have an exclusive for club members, the advanced 10 sessions, which we always say you need to have this one, which is free without being a club, but the other one is advanced and really taking you to the next level of being more professional investor. So this is only for club members. You're all welcome to visit the club page in order to see how to join the club. But other than that, Sam and I check for us in wherever you want, LinkedIn or Twitter or through your account manager. Feel free to ask questions and we will be happy to help you. Yes, Victor, 4 same sessions, only using different companies, fine-tuning the last quarter session and trying all the time to bring more and more things in order to improve. And obviously, you're always welcome to give requests. And we really encourage you to follow the Digest and Invest. Sam is creating content on a weekly basis from practical trading. Josh is doing the stock break. So you have a lot of content to consume all the time, which is free for you all. So just go through Digest and Invest. You can download in every type of podcast. You can watch it in YouTube. So literally you have a free and high quality content that you can use on a daily basis.
Yep, absolutely. Links in the chat there as well.
Enjoy all.
Yes.
Yeah.
Thank you very much, everyone, for joining.
Thank you all. We hope, and we really appreciate your, spending time with us. Really,
yeah, absolutely. It's been a pleasure.
If you enjoy it. Yeah.
Take care, everyone. Have a good rest of your
Thanks,
week.
guys. Thanks. Stay safe.